Hey everyone, this is George Bayruthi from FS Securities, a stockbroking firm on the Gold Coast in Queensland, Australia. And today I'm going to show you part 4 of our CFD trading. And by the way, there are two events taking place in our trades. First of all, we've increased our capital outlay from $500 to $3,500. And I'm also going to show you how we've entered a foreign exchange trade, that is the British pound against the US. And by the way, the reason why we've increased our trades volume is because initially I wanted to show that you can start trading CFDs with very little amount, and of course small amount will give you small return. And then now I'm showing you that you can actually go into the CFD trades, again lower risk than options, and you can actually increase your return based on what you can do, and also with a variety of things you can do trading CFDs. So first of all, why we want to trade CFDs? Well, we want to trade CFDs because it's leverage, and leverage means you can actually more than increase your return if you are correct. Of course, everything we do has got risk and rewards, and provided you know what you're doing and you understand the trend is your friend until the end. Of course, charts will show you the trend. However, you need more than the charts to indicate where the trend is no longer your friend. And once again, before we take any action, remember that our presentation is for general advice only, and you need to be cautious. So we started our trading in CFDs with $500, and within few weeks our $500 increased to $1,500. That was nearly 300% return. We now entered the trades with slightly bigger volume, and I'm going to show you that we've added an extra $3,000 into our account. So today we have our capital outlay so far at $3,500, and I'm going to show you today how we've entered a trade on the British pound versus the US, which by the way initially went wrong however, and now we've managed the trade, and this morning we are slightly ahead in that trade. So please enjoy the presentation, and if you like the presentation, we always like to see some feedback from our readers. Okay, here we show you that the three different entries. We initially had $500, and you can see here our balance at that time was $1,500. So that is, as what I showed you, 300% return on our initial 500, and that was on the 1st of August. On the 5th of August, we've put an extra $1,000, transferred the money into the account, the trading account. On the 6th of August, we've added an extra $1,000, and on the 16th of August, we've entered another $1,000. So now our trading in total, based on the previous results, was $4,839. But as I mentioned before, we've had a couple of setbacks. One on the British pound, which went wrong, but then we recovered, and I'm going to show you how we managed the account. And then Appen, which was trading around the $32, managed to actually, when we've had the very big drop in our market, of course Appen was affected, and we had some position that ended up in a loss. But however, we continue to hold on those positions because we believe Appen in the long term is going to recover. But let's focus today on the foreign exchange trades. So here we go. On the 19th of August, we've entered the trade with 100,000 units, that is the British pound versus the US. That was actually, in terms of value, $179,000 approximately. And today, about 8 o'clock in the morning, we've decided to reduce that particular position from 100,000 to 50,000. And the reason why, I'm going to explain it by using charting technical indicators. By the way, in trading foreign exchange, of course, you need to understand the fundamentals, and the fundamentals have an important factor. But obviously, if we're trading in and out of the market, technical analysis will help us to make a decision. Of course, our technical analysis has got a probability of 70% success. So it's not really relying 100% on the technical indicators, but you need to manage it. And by the way, we run a lot of courses and we teach you how to actually use the tools, that is the tools, and then the education will help you to learn how to use the tools, and then more importantly, the discipline in the trade, that you have a strategy before you enter the market and maintain that strategy and hold it, not to change it, because often even the best traders in this world will actually start to filter or try to change the strategy as we watch the screen, and we alter our strategy as we go along, and that is the lack of discipline. You've got to hold on to your discipline. You've got to really maintain that particular discipline, and if they're going to have a loss, hopefully the trading stop loss will help you to get out when you need to get out. All right, so today we decided to reduce our trade from 100,000 units to 50,000 units. This is actually on the left hand side, the trade. We can see here we have some bullish signals. First of all, the stochastic, we're indicating bullish, and the candles in relation to a lot of those indicators. As you can see here, we've got a lot of indicators that look like a spaghetti bowl, but anyway, they mean something. And of course, in our education program, we teach you how to read those signals. This morning we've seen that right here on the right hand side there is a bearish indication, and the signal also by the stochastic tell us that it's better to reduce our trades from 100,000 to 50,000 and reduce the risk. We will still maintain our bullish position on the British pound against the US, because fundamentally we expect that the US dollar will drop because of the interest rate falling, and hopefully that the British pound will gain against the US. Now on the technical side, now the next chart, oh by the way, this is a 5-minute chart taken this morning at 8:40 a.m. So we decided to make a decision and reduce our trade at that time. And by the way, our $3,500 outlay still in profit by $496. So we're still 12% ahead in the market. But by that way, that's actually based on a much bigger volume, much bigger outlay. Now looking at the daily chart, again taken at 8:40 a.m. this morning, looking back several days, maybe about 4 or 5 weeks, we can see the first indication here where that orange line has dropped below the pink line. These are moving averages. The 50-day is the orange, the pink is the 100-day. When the 50 dropped below the 100, that was the first signal of a bearish signal. So that's the first bearish signal. Then we've seen another bearish signal when the 50-day moving average dropped below the 200-day moving average. So that is another bearish signal. Looking where we are, our trades, why we entered the trade, well, I guess in a case where there is a little bit of lack of discipline here, because the trade that we've entered, we try to speculate that the change in the market based on knowing what the fundamentals were, an expectation of a drop the interest rate, we entered the market perhaps a bit prematurely here. And as we entered the market, we found that the market dropped quite a bit, and this red candle caused us to have a lot of losses. But we maintained our position and we kept it going, and we recovered and we are slightly in profit right now. The stochastic, of course, gave us a good signal in here as well. But because of the 5-minute signal that we've shown you in the previous slide, we decided to reduce our risk and we got out of the market. So that is our new trade, and let's watch how the trade goes on from here on. Now, why we trade CFDs? Well, I mentioned to you it is a leverage product, which means that it helps us to actually increase our profit if we are right. Of course, it will increase our losses if we are wrong. First of all, CFDs stand for contract for difference. It's a contract between two traders. Normally one is a buyer and of course the other is a seller. Now, if you are a buyer, you expect the market to go higher. Against your speculation, there is another trader who believes in the opposite direction, and both of you come together, not necessarily John versus Paul. It can be John versus any person in a basket of traders, and you enter the trade, and if you are right, you make the money. If you are wrong, you lose. And why we call it contract for difference? Because the entry price versus the exit price is the difference. And if it goes in your direction, obviously you've sold at a higher price than when you entered the market when you bought, and that difference is your profit. And we call it a contract between two people, and the difference is the profit or loss. And once again, we want to tell you there is no guarantee when you trade any instrument in the financial world. However, if you are well educated, use the right tools, and you have the right discipline, you have a better chance of making money. So now, if you want to learn how to do it, now of course we have many courses that we can actually teach you all those fundamental and technical. If you have any questions, of course you can ask us. This, of course, before we give you the details of our contact details, our disclaimer. You need to know that our presentation is of general advice nature only, and before you take any action, you need to consult with us or consult with your professional advisor. Okay, if you want to ask questions, you can write to me directly, george@fssecurities.com.au, or you can call me on my mobile. I'm available almost 20 hours a day. If you're ringing from overseas, it's 61. You don't need the 0. That is my mobile number, 411-259526. I hope you enjoyed the presentation, and as I mentioned earlier, this is part 4 of our CFD trading. If you missed the first 3, all you have to do is call us or write to me, and I'll send you the presentation. Happy trading and good luck.